It's clear that the world has profoundly changed. We come from a world that was, it's always volatile, but if you go from 82 until recently, well, it was a world that was centered around the United States, relatively stable, inflation that was more or less under control, interest rates that came down, commodity markets that were not too high and not too volatile. Well, with COVID, I think we've moved in a totally different world, a world where demographics, where climate change, where changes in globalization will make that we live in an environment where inflation will be structurally higher and interest rates will also be structurally higher, which means that companies, consumers, investors, they will all have to position for that, and we live in a totally different environment. Second point is we live in a world of AI. How AI is going to impact us, whether robots are going to kill us or going to take over all our work, we'll have to see. But also I think this is going to change everything for businesses. Everybody is hiring AI people because everyone wants to be on board. In terms of investment, this is also extremely complicated. We talked about it extensively. How do you invest in AI? Do you go for the Magnificent Seven or others? We look at a combination, but this is totally different. And then the third point, that's not so nice point, are we going to go to war? And we already have for the first time in many years wars in Europe, in Gaza and other places in the world. This is what Neil Howe calls a fourth turning. A fourth turning is a situation where you have conflicts between nations, but also where populism, and we have seen that in the elections that are coming up, populism is growing everywhere. That will complicate things. Now, the key message maybe of these 3 points is the challenges are enormous, but the opportunities are even bigger potentially, and that has me extremely excited. Well, if you make a prediction over 20 years, it takes a long time before the market proves you wrong. If you look in your crystal ball for the next 18 months, well, it's more complicated, it's more difficult. And I must say, I've been doing this for 30 years now, and this is the most difficult environment to read I've ever seen. Because you come out of COVID, where everything was locked down, you got a lot of excess savings, then you open up, the consumer comes back, you get a boom. On top of that, you get Ukraine, complicating the supply chains and so on. So the economy is extremely difficult to read. You see that in all the figures that we see. If you look at the services side, it's good. If you look at the manufacturing side, it's bad. The job market, as we saw recently, is still strong. So it's very difficult to read. And that's also difficult for a private bank at this moment to position the clients. So even though I'm very optimistic for the next 20 years, there are challenges, but even more opportunities. In the short run, I would err on the side of caution, because remember, we had 2 very good months at the end of last year. November and December were very strong for equities. The first quarter of this year first half year in fact was very good. Now you get May, the more difficult period of the year, May, June. So I would be a little bit more cautious in the short run, because I think the market is putting a lot of focus on the Goldilocks scenario. No recession, but still inflation that comes down and interest rates that come down. That's the consensus. The consensus is often wrong. So even though I think there are a lot of opportunities going forward, for the next couple of months I would be a little bit more cautious.